Selling a home can be a complex process with several financial and tax-related considerations. While the sale might seem like a straightforward transaction, it can have significant tax implications that could affect the amount of profit you ultimately pocket. Understanding the tax rules and how they apply to your home sale is crucial to avoid surprises and ensure you're making the most of your financial situation. In this video, we'll explore the top 10 tax implications you should know about when selling your home. 1. Capital gains tax may apply to your profit. When you sell your home for more than you paid for it, the difference between the sale price and your purchase price is considered a capital gain. If your capital gain exceeds the exclusion limit, you'll need to pay capital gains tax. However, most homeowners can exclude up to $250,000 in capital gains, $500,000 for married couples filing jointly, from taxation, provided certain conditions are met. 2. The primary residence exclusion rule. The IRS offers a significant tax benefit known as the primary residence exclusion. If the property you're selling was your primary residence for at least 2 of the last 5 years before the sale, you may be able to exclude up to $250,000 of your capital gain, $500,000 for married couples filing jointly. This rule applies to homes that are lived in as the primary residence, not vacation homes or rental properties. 3. How long you've lived in the home affects tax exclusions. To qualify for the capital gains exclusion, you must have lived in the home for at least 2 of the past 5 years before the sale. The 2 years don't need to be consecutive, but they must fall within the 5-year period ending on the date of the sale. If you haven't met this requirement, you may not be eligible for the exclusion, and your profits may be subject to capital gains tax. 4. Partial exclusion for special circumstances. In some cases, you may be able to claim a partial capital gains exclusion if you had to sell your home due to certain life changes, such as a job relocation, health issues, or other unforeseen circumstances. If you meet the requirements, you can exclude a portion of the capital gain based on how long you lived in the home during the 5-year period. 5. Improvements to the home can lower taxable gain. The IRS allows homeowners to subtract the cost of home improvements from the amount of capital gains they need to report. This means that if you made significant renovations or improvements to the property that increased its value, you can add these costs to your original purchase price, lowering the taxable gain. Be sure to keep detailed records of all home improvements, including receipts and invoices. 6. Selling a rental property has different tax rules. If you sell a property that was used as a rental, the tax implications are different from selling a primary residence. Rental properties do not qualify for the primary residence exclusion, so you will be subject to capital gains tax on any profits from the sale. Additionally, you may need to pay depreciation recapture tax on any depreciation deductions you've taken during the time you owned the rental property. 7. Depreciation recapture tax on investment properties. If you've claimed depreciation on a rental property over the years, the IRS requires you to recapture that depreciation when you sell the property. Depreciation recapture is taxed at a maximum rate of 25%, which is higher than the capital gains tax rate for most individuals. This can significantly reduce the amount of profit you take from the sale of a rental property. 8. State and local taxes may apply. In addition to federal taxes, state and local taxes can apply to the sale of your home. Some states have their own capital gains tax rules, and others may impose a real estate transfer tax or other fees when property is sold. It's important to check your state-specific tax laws to understand how your home sale may be taxed. In some cases, your state may offer exemptions or deductions that can reduce your tax liability. 9. Mortgage debt and tax implications. If you sell your home and have outstanding mortgage debt, the amount of debt you owe does not directly impact your capital gains tax calculation. However, if the sale price is not enough to cover your mortgage balance, you may face a short sale. In this case, the lender may forgive the remaining balance, which could result in a cancellation of debt income, which may be taxable. It's important to consult with a tax professional if you're facing a short sale to understand any potential tax consequences. 10. Tax implications of selling a home in an inherited property sale. If you inherit a home and later sell it, the tax treatment is different from a regular sale. When you inherit a home, the property's value is stepped up to its current market value at the time of the original owner's death. This means that any capital gains taxes are only calculated on the difference between the sale price and the stepped-up value, not the value when the original owner purchased it. This can significantly reduce your capital gains liability when selling an inherited home. Selling a home involves numerous financial considerations, and the tax implications can be complicated. Understanding the rules around capital gains tax, exclusions, and the different treatments of rental or inherited properties can help you minimize your tax liability. By keeping detailed records of your property's purchase price, improvements, and the length of time you lived there, you can make the most of the tax benefits available to you. Whether you're selling your primary residence, rental property, or inherited home, it's crucial to consult with a tax professional to navigate the tax implications of the sale and ensure that you're maximizing your financial benefit.